Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode.
Okay, good evening, guys. Welcome back. How have you been doing this week? You enjoying the lighter? It seems to be getting a little bit lighter, which always seems to. Actually, I saw a funny picture. Sorry, it just come to me now. Of apparently there's like a period between December and January. It's like the 10 darkest weeks of the year. But why not just extend it and then they become the 11 darkest weeks of the year?
Yeah, that seems arbitrary.
Yeah, so because everyone's talking about these so-called 10 weeks. Why could it not be the so-called darkest 11 weeks? Anyway.
Could be. Yeah. What a nice start.
One thing to think about when you're in the bath later.
I've done myself a good deal this year and last year in this time when I went off to India twice. So I had much more sun than you guys. Yeah, but hey, what are we chatting today about?
Really, not a lot.
Whatever is on your list.
Yeah. Okay. So because we don't have any of the founding news.
By the way, I would say actually we do, but we were waiting for one of the founders of one of the companies you wanted to speak about to join us. So next week we will do that.
So
too popular.
Hell yeah.
Right. Yeah. So basically, we don't have anything for this week. That's why we will head off with my questions. So recently, we spoke with one of the co-founders within our space, and they are raising another round from investors, and they clearly struggle with that. And one of the comments that he made to me is that it's very difficult to find late-stage investors which would invest within the late stage in construction tech. So, Patrick, you are doing seed, pre-seed, but you also follow up with your own portfolio companies. What are your thoughts on the market within construction tech? Is this really a problem?
Sorry, mine. Can we just add that it was a Series B round, right? They were looking to raise.
Yes.
So that was going to be my question. Thanks. And how do you guys remember when the company was founded?
I think 2017.
Okay, got it. So the reason why both of those things are important to consider in context is because when construction tech generally all of them, but construction tech companies came up through, before 2021, then it can have happened, which I don't know this specific case, so you'll have to help me contextualize, but it can have happened a lot that sometime between 18, 19, especially 20, even more 2021, an overpriced round might have happened. A lot of money might have been invested. Investors demanding then a lot of growth and, hey, why don't you burn more? Why don't you grow more fast, etc. And so these are then things that after 2021, if you didn't perhaps nail all of those metrics, you didn't achieve all of the milestones for your, in this case, Series B, you're now carrying baggage. And so that's an unfortunate reality that maybe, again, I don't know the case, but this company is confronted with, and others that are coming from the same vintage era, 2016 through 2021 founding dates and raised a lot of perhaps seed, or in this case, sounds like Series A. They have to kind of justify that baggage. Now, that's never an issue if you actually hit all the milestones. You grow to the rate that you want. You have the margins that you want. You have also, from a receivables perspective, the cash flows that are desired depending on the business model that you have. You nailed the hirings. Customers are happy. If you nail all of that, it doesn't matter when you were founded. But if you deviate from one or more of these, and you came through those vintage years, and then you burned too much in relation to that, I do see that a lot the last 2 years.
Mm-hmm. So what are the ways moving forward? Like in the case that they, well, I guess I know the answer. In the case they don't find a follow-up investor, but what before we know this, what are the ways to raise capital?
So look, let's differentiate perhaps a few situations that you could be in. I mean, for a long time, the venture industry, founders as well as VCs, propagated SaaS, software as a service, as the best model ever. So let's start with that one. If you truly have the recurring business of SaaS and you are very sticky, which in construction, it is absolutely achievable as a SaaS to be super sticky product, then you have a lot of recurring revenue. And if you have that, you can use it to sustain the overhead in order to stay afloat, so to speak. Pay your own salaries, pay your R&D team, perhaps scale down on the sales and marketing team, depending on what the margins of your sales and marketing team are. Or the other way around, you could retain your sales and marketing team if they are successful, but maybe scale back on the product development for a year. So actually in a SaaS model, you should be able to scale back and sustain. Mm-hmm. That's possible. Now, interestingly, not a lot of SaaS companies actually are that way. And so the founders in these cases don't ask themselves all the time the hard questions of, hey, why am I actually not able to become profitable if I have to in my SaaS model? And then problems lie maybe exactly in those corners that prevent you from doing the round that you need. So that's maybe a SaaS context to consider. But if you're actually a SaaS company that has good business, you can do that. Secondly, oftentimes founders shun strategic investors early on, again, for propaganda that has been taught in the whole venture industry for many, many years, which I dislike because I think it should be a case-by-case decision. And actually, there are terrific strategic partners that are run by highly professional individuals with the right incentives. But I'll admit, those are far and few between. But all I'm saying is come from the first principles. And then when the proverbial S hits the F, then all of a sudden, maybe the professional investors don't want me anymore. Now they are shunning me. Let me now go to those strategics. If you haven't burned those relationships, that might be an open route for you. Now, if you have treated them really poorly, these people have memory too. And unfortunately, I've seen that happen more than once. So hopefully you kept those doors open, kept the mattress warm, made them happy, and now that might be a real option for you. If that isn't an option, banks probably won't give you debt if you're a burning business. If you're a marketplace and you can actually operate profitably, like in our portfolio, we have 10 such companies in total, then actually bank debt is an option. Not venture debt. Venture debt is something that, you should be careful about, but bank debt in traditional terms is something that then might be an option. Now, if none of those three things are a route for you in this kind of scenario, then the option space becomes very narrow.
Mm-hmm. Have you come across a situation where, like in banking, for example, there's this like a buyer of last resorts, and usually there are central banks, right? That in construction tech, perhaps we had reasonably good company, and they were not able to raise further capital at later stage, and they were bought by incumbent.
Yeah,
for
of course.
cheap.
I mean, sorry, I kind of took your question as, hey, let me keep carrying on, right? So you're right, of course, an option could also be then actually to try to seek an acquisition and try to seek an exit. It will depend a lot on your runway, though. So unfortunately, an M&A process to a strategic buyer, it is hardly doable in less than 6 months. And that's the fast timeline. Not to say it hasn't happened, it has. It's rarely doable, and typically it needs 12 to 18 months of relationship building. Also because the buyer wants it. The buyer wants to date you, get to know you, etc., etc. So it doesn't exactly match the situation that you're describing, Martin. all that well. Typically, if that is your very last resort.
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
You will not end up with the offer that you hoped for.
Yeah, so downsize and be profitable is probably the answer in one of the options.
Yeah, if your margins actually allow that.
Yeah, are
Yes.
people not? Are people? Is maybe it's a stupid question. Maybe it's not. But are people not being profitable because they're just trying to grow? Or the other well, but apart from perhaps they just can't be profitable because the product isn't good enough. Is it purely a growth choice?
I'm seeing all sorts of colors in construction tech, quite honestly. I think, again, if we dial back to 2021, very often it was a combination of growth and unprofitable growth, actually. So meaning you scaled something that inherently was unprofitable, for example, contribution margin negative. I've even seen cases in construction tech marketplaces that were gross margin negative. At the time, I remember a totally egregious example of a wood marketplace that was actually gross margin negative, and they were growing fast. Now, when I teleport your question, Owen, into the year 24 and 25, no, it's usually not the growth that is burning a lot of capital. It's often the amount of product development that has to be done, especially in a US context. People propagate, oh, AI has made everything so cheap. I cannot confirm that, I have to say, in a US context. In a US context, the product development is actually more expensive than ever, in at least in the spaces that we see. Even more so when the minimum feature set is very high. Think robotics, think authoring tools, or generally the design stack, for example. So that could still be a reason why you're burning a lot. And unfortunately, I'm also seeing just poorly managed companies where the contribution margins are negative. And so if that's the case, you just cannot by definition become profitable. And whatever you're scaling, you're just scaling yourself further into hell. And I see that across construction SaaS as well as construction marketplaces.
And can this not be turned around internally within the business from these contribution margins to be positive? Because I guess at this early stage, I guess it's impossible. But in the later stage, you probably should have an idea how you are going to break this point of profitability at some point.
Even early stage, I'm seeing it. It will depend on which market you're in. So, coincidence, right? I didn't know you were gonna ask me this question, but today I spoke with a founder whose company is about 4 years old and it originally had a SaaS software, and they burned a little bit of money with it, and then they realized, hey, this is never gonna work. And then without investor pressure, just savvy entrepreneurs, they actually said, okay, let's put a hold on this until we figure it out. Let's pivot. Let's actually sell outcomes to our customers. We just happen to use our software, become profitable, and then reevaluate how we now make this thing big again. That's because they operated in a part of the construction P&L which had very sick margins that they sold into. So that worked. If on the other hand, you're in a part of the market, to give you an example, if you're a marketplace that is buying from wholesalers and selling to retailers construction materials, that is a very, very difficult pocket of the market to actually ever become profitable in the Western world. It can work in emerging markets, just because the labor cost will work to your benefit a little bit better. But it will depend very strongly on the pockets. I have seen those turnarounds rarely, but I have seen them across the stages.
Did we speak a few weeks ago about late stage funding being like nearly not non-existent, but what's the right term here? Like not
rare,
like low, rare, yeah, in the construction tech space too. I think we did mention that, right?
Yeah, we did. And I think Q4 was a clear plummet compared to Q3. In general, the late stage funding of construction tech, except for the most recent quarter, has actually been disproportionately better than the overall VC industry. Every quarter, you can find it on LinkedIn, guys. Every quarter, like immediately the week after the quarter's end, I'm publishing the funding stats. for construction tech, and then also comparing it with general venture. That's why I know this. And so in general, the late stage funding disproportionately in construction actually is better than in overall venture, except for Q4. But we'll just have to see how it tracks in Q1. But look, it's the amount the capital is there, but you have to have a supply of high quality firms that are deserving of that amount of money. And so, of course, there are always outliers that kind of can keep raising big rounds on more and more promise. I would say we're seeing that in the general AI space. But at some point, the party is over. At some point, narrative does not carry you anymore. For some, that point comes earlier. For some, the point comes later. But believe me, after all, in the end, if you're not lucky enough to run into a 2021 type exit window where the whole market is just frothy in terms of liquidity, if that's not the luck you're having, you will at some point have to demonstrate substance.
Yeah. Mm-hmm. So how can they prevent? So one of the scenarios I think you mentioned was like raising too much, right? And I actually don't know the history of this company, so I don't know if that was the case or not. But theoretically speaking, if we were to provide some value to our listeners and perhaps founders, how can people prevent themselves from a temptation of raising too much money? And because that would then make their follow-up runs even more expensive, right? So and it might be difficult to get to get the money for that.
And I'm only allowed to give one tip, right? You want one tip?
Yeah. Maximum
one tip. Okay, so if you put pistol to my head and say, hey, only one tip, then I would say the biggest needle mover is if you stop listening to the venture industry, you stop listening to other VC-backed founders, you stop listening to other VCs, especially those who are part of propagating the system to keep it running the way it does. Stop listening to those and start listening to un-VC type entrepreneurs. That's a term we use internally. Listen to people who have built real businesses, who have built businesses that sustain and stand the test of time. And they will give you the information that you need in order to get there as well. And then the only remaining question is, how can I get there faster? And that's why I'm a venture. I'm not a venture because I can raise and tell a narrative. I'm a venture because I have a plan for a sustainable generational business, and now I want to know how I can get there faster. Listen to those guys.
So maybe if theoretically, if we were to tackle like mechanics behind not too large but too expensive round, so if let's say Series A was at $30 million. Right?
Okay, that's a large Series A.
Yeah, so then mechanically, what needs to happen for Series B being justified at what level, if there is an answer to that? Or how the rounds are priced one after another. If it was at 30 million, yeah, you can put whatever, 40 million, 50 million, whatever it is, or 10 million. And how does the next evaluation would make sense, and at what level, or what are the mechanics of that?
Let me give you the abstract mechanics, and then we'll contextualize it a little bit for different types of construction tech type models. So in general, there is a number of rounds where the valuation is found not from any kind of substantiated calculation. I can tell you nobody does DCF analysis, nobody does NPV analysis, or all the things that, finance people have learned about M&A transactions in early stage, even late stage venture. Nobody's doing that. The way for a number of early rounds it is done is, hey, the founders ask for a number of a round size, the investors ask for an ownership target, and you divide the one by the other, and boom, there's your valuation. You're haggling over, is it really this much money that you need? And guys, believe me, there are even investors who are then telling the founders to take more money because they want to put more money to work. That shit happens, right? Which is very, very unhealthy, potentially, to the company. But that's for a number of rounds. What happens? Because quite honestly, there's no other way how you can determine the value of a business at that early stage. There are no peers, no benchmarks, there's no DCF, nothing. So that's the way it is supposed to work, but can create some perverse incentives of just blowing up the round size. At some point, this party ends and your startup will get valued on real substance. The real substance depends very much on what type of business you're running, what market context you're in, etc. Let's take a marketplace that it does building materials, that does construction labor, something like that. At some point, you will get measured by the amount of GMV, gross merchandise value, that you transact, then how much net revenue you take from that, what is your gross margin on that, what is your contribution margin on that, and people will apply benchmarks that actually carry a lot of weight in these types of marketplaces. You will get judged by your cohorts. Cohorts mean how often do your customers come back, what kinds of baskets do they buy when they come back. The same question for suppliers on your marketplace. In SaaS, the same thing. SaaS has a very standardized way of being evaluated. Also, cohorts play a role here, ACVs play a role here, LTV, CAC, you can look that up, everything written about. At some point, my point is, this changes and you will get judged by relatively obvious and transparent numbers. And then for that, multiples get applied. And so the multiple then is, let's say, whatever, you're a 10-year-old SaaS company, you have 10 million of ARR, and someone will tell you and argue and haggle with you why it should be a 10x multiple, maybe a 12x, maybe you are saying 15x because this and that.
But does it have to be A, B, C round, or does it matter the number?
It really depends completely on what kind of market context you're in when this effect kicks in. Sometimes the effect kicks in at a seed round, sometimes it kicks in at an F round. It is completely market contextual. A normative, just market average would be that an A round gets partially already valued on substance. At a B round, you definitely get valued on substance for most of the deals.
Okay. Yeah, so basically based on what you said, seems like they perhaps didn't have the right numbers, so that it's not justified. Okay.
I mean, what's also always an option is, but then the shareholders need to be open to it, is that there could be substance in the firm, in the example that you gave, but maybe it was overvalued the last time because it raised too much. It didn't grow into that valuation with the substance that it now gets valued on. And then people need to be open to, okay,
downsize.
Exactly. Can we recapitalize the firm? Can the existing shareholders please, dilute back? We're going to revalue the firm in a different way. That can be quite painful, but at least we can keep going. Then there will always be, there are some weird dynamics sometimes where a new investor pits the founders against the existing preferred shareholders, all kinds of weird dynamics, but in a good, healthy cap table, it can absolutely work.
Is it also possible that the founders would lose some equity? In general question, if founders decide to lose some equity towards the new investors so that the old investors will not get diluted?
Yeah, that happens all the time in every financing round. If it's a down round or a total recapitalization, that rarely happens. So it can happen, but what also happens, and that's the weird dynamic, is that sometimes the founders actually get more shares so that they help the new investor recapitalize against the will of the other preferred shareholders, because it's obviously very difficult to keep a company running without its founders up until a certain point. At some point, when a company actually already has some substance in it, the existing shareholders or a new shareholder sometimes might also just push the existing founders out and say, hey, let's find a new management team. So there can be some very weird dynamics when you don't hit your milestones.
Okay. I'm very satisfied with this answer.
I have a nice anecdote actually on this one.
Learning. Patrick, we were going to ask you, 24 past, we were well into now 2025. What did you change your mind on in terms of construction tech investing in the last year or so? What have you learned? Or what
have I learned, or what have I changed my mind on? Because I can also learn things in terms of reinforcing my belief.
I think that's also fine.
Yeah, you can broadly attack this question.
I've reinforced my beliefs of looking for un-VC founders and true blood entrepreneurs. I think I have developed a very strong taste for people who have had very quirky reasons to get to the founding place in construction tech, why they are there. I don't have a taste for top-down derived, hey, this is an opportunity and that's why I'm going to attack it, or hey, this is something that worked in another sector and that's why I'm going to do it. I never had a taste for it to begin with, but my taste reinforced very strongly in the last year because I'm having success with it. And maybe not as much success with the other. Doesn't mean the other doesn't work. It's just not my taste. So that's what I've reinforced. And the more quirky, the more winding your road is, the more life hit you in the face, and the more that comes then with I call it the onion founder internally. So the more layers I can peel off of you and the deeper insight comes as a result of all those quirky things that you did, the more attracted I am going to be to you as a founder for construction tech.
Mm-hmm. Yeah, and we spoke with a few people that you can feel like you peeling the peeling the onion.
It's a metaphor, right? But it's weirdly evident when you speak to these people.
Yeah, it is a metaphor. Yeah. It's not a real thing. That's right. Yeah. It's not
okay, I was just onion.
Checking. We were not undressing anyone.
Hey, Patrick, maybe you should. There was someone I think who should be on your watch list. And the post actually
giving him advice.
The post went a little bit viral last night or maybe today about someone who got fired from Autodesk and is now going for a full-time pursuit on YouTube.
Yeah, I saw that. It did have a little bit the vibe of, oh, I got fired and now I'm spinning it as, oh, these California people are canceling me and now I'm speaking out finally. Okay, cool.
Yeah.
I mean, I saw this clip as well. The guy had like 70,000 followers. Yeah. So
I thought it was cool that he was working for Autodesk and had a very successful YouTube channel. Yeah. He actually made like 40K ad revenue as well from it last year, which was also impressive. So maybe quirky trait.
Good.
He should have left a long time ago.
If you're living in Silicon Valley, like this person, Mas, 40,000. Is that your monthly rent now there?
I would say that would last you a month, maybe a month and a half.
Yes. Yeah.
Poor guy.
Crazy. Okay, what have you changed your mind on?
I've changed my mind that I actually think Europe is gonna be way easier to make money as a construction tech investor than the United States.
Ooh.
I'm not
as
saying
a construction tech investor. Okay.
Yeah, I'm not saying. So watch my wording. I'm not saying I have changed my mind that the US will deliver the bigger outcomes. I still believe that, but I think you're going to make more money as an investor in European construction tech companies than in US companies as a portfolio investor. If I'm not building a portfolio and I have perfect picking ability to know the one project that will go generational, I'm going to make more money in the US.
Is it because of less competition in terms of VC? And most of the money is going to US?
No, it's not less competition actually. On the VC side, there are quirkier traits in the markets in Europe. There are hyper talented founders in Europe. The cost structures, the US people don't understand just how disadvantageous their cost structures have become. They think it's a reflection of liquidity and ambition. And it's almost a boiling frog syndrome, where I'm sitting outside of that pot, I'm looking at it and I'm saying, hey, if you would just be building your 3D company, your robotics company in Europe, you would have a 4 to 5x cost advantage and you could achieve way more. And by the way, you could still build for the US. You could still market it in the US. You could still distribute it in the US. Yeah. It makes no difference. So that's one of them. 2, it's very, very difficult in the US to keep your company and your hidden insight under the wraps and build for a long time without a horde of category clones coming after you and also receiving a ton of funding. It is a lot easier to actually keep your trap shut, not telegraph your plans to your competition, and build for a while here and actually build that sustainable track record and competitive advantage in construction tech if you start in another market. There are a few other factors here. And again, I want to be on the record. I'm investing in the US. I will make money in the US, but I have changed my mind that I actually think Europe is going to deliver much better returns as a whole for construction tech investors.
Interesting.
Yeah.
Interesting. I thought we were going to the ground, but if you say so, then you're looking at things from a different point of view.
Yeah.
But
when there's blood on the street is when you should buy.
I thought it was only about Bitcoin, but it seems like not only.
Sorry, that's your market, bro.
Martin, what did you change your mind about?
What did I change my mind about? Interesting question. Okay, so that's not gonna sound good, but I'm gonna tell it anyway. So, as much as I hated running structural engineering business for the market I've been running it in the UK, I feel like it's becoming a better and better asset for me because it is a very good cash flowing thing. And previously, I wanted to do something different. Right now, I think it actually makes sense to steady grow the business in the direction where it's going. So, yeah, that's probably it for me.
Very good.
What about you, On?
I was going to keep it more construction tech related, actually. We had this debate a few times, and word on the street in discussions maybe 12 months or so ago with people about how there were too many point solutions within the construction tech space. But discussions I've had recently is with innovation managers, directors, heads of innovation at general contractors is they're actually willing to try a lot of these tools out. I don't think their viewpoint is that there's too many point solutions. If the point solution exists and it solves a major pain point for them, then they will try. So
I actually have a feeling from I haven't concluded it yet. It's just an intuition based on, I don't know, 6 months of anecdotal conversations that GCs will stop purchasing point solutions at some point, will put a halt, and will look for
Consolidate.
Exactly. We'll look for a way to somehow consolidate their tech stack.
Yeah, I think it's impossible to keep adding point solutions. You need logins for each of those. You rotate your staff, and it's just such a pain. So, as much as they are solving a problem, I don't think you can efficiently scale organization having so many of those and just becoming a pain. I think where we're going with AI is that maybe there will be a lot of point solutions solving problems quickly, but at some point it has to consolidate into something that is capturing the larger part of the workflow rather than just a point in it. Just my feeling.
Yeah.
So let's watch that.
Let's watch it. Okay, guys. Thank you, and we will see you next week.
Thank you, guys.
Thank you.